Okay, welcome back, guys. Today we're going to take a look at a health services company. They do nursing. It's called Universal Health Services. They do nursing homes. So let's take a look at what they do. Well, over the past 5 years, they are up 44%. They have underperformed the S&P 500. Their all-time chart looks pretty decent. It's basically just up and to the right, which is always good to see. They are in a growing market because there's going to be more and more old people. So yeah, that's always a good thing. It's a market cap of 10 billion, so a pretty large company, but they definitely have room to grow. And the price to earnings ratio is 14, so not too high. Let's take a closer look at their financials here. They have steady revenue growth of about 5 to 6%. They had 9% here, they had 2% here, but I'd say overall about 5 to 6%. I'd probably expect 5 to 6% moving forward as well. Their margins are pretty consistent. They did get squeezed recently. However, I think that they're going to be able to get back to 7% profit margins. Yeah, translates pretty well into net income. They buy back some stock. Let's take a look at the balance sheet. Balance sheet looks pretty good. They have net debt of 5.25 billion. However, it does look like their book value just continues to go up every single year. That's always good to see. It means that they're expanding in a sustainable way. Let's take a look at their cash flow. What are they doing with it? Well, they buy back a lot of stock, so they barely pay much of a dividend, and then they buy back mostly stock. And then they have taken out some debt, probably for expansion. Let's take a look at their stats here. Their return on invested capital is about about 6 to 10%. So it's decent, but it's not great. And their gross margin, their net margin mostly is what we got to look at. Net margin, it was 7% and it has dropped down to 5% recently. But I would expect them to get back to 7% at some point. Let's take a look at what the analysts think. Yeah. The analysts think they're going to grow, so 13.72 going up to $15 per share. That is like a 15% increase, which is pretty insane. Or no, 10%. Oh yeah, that's like a 10% increase. And then the revenue estimate, well, they're estimating revenue to grow by 9% this year and grow by 5.5% next year. So pretty decent revenue growth. I think that they'll be able to hit that just because it is a growing industry. So let's check the stats, see what the short percentage is looking like. The short percentage is 4.5%. That is kind of high, which is not what I was expecting for this business. Seems, yeah, I'm not quite sure why people are shorting, but that could be a red flag. It's not 5%, or I mean, it's not higher than 5%, so it's not horrible. Let's take a look at the DCF model. And I put their estimates here: revenue, earnings, buybacks of 500 million, net debt of 5.2 billion, discount rate of 10%, exit multiple of 15. They're currently trading at 14. I think 15 is fair. You could even probably push this to like 18, just because it is in a growing industry, and they have been consistently able to grow over the past years. So their growth, 10%, that's the analyst estimates, and then slowly dropping off to 5%, more in line with their revenue growth. Because, like I said before, I think they're going to expand their margins back up to 7%. And in this case, with a 6% revenue growth going down to 5% revenue growth, very sustainable growth. I think they could easily do this. And we're looking at a fair share price of $262. And accounting for debt, then it's still undervalued. Still undervalued at 184 is the fair share price. And you could even push this exit multiple up to 18. But of course, it's always possible that this company doesn't quite do these numbers. It's possible that they stay around 6% margins. Let's just say that that happens. This, I think, would be a more bearish scenario. And yeah, I'd say there's still like pretty decent value. You could put the fair share price around where they're at now, even accounting for debt. So yeah, it's not a bad business. This is a company that I would not be opposed to opening up a position. Um, there's other companies out there that are better, of course, but yeah, definitely nursing and nursing homes are definitely not going away. So yeah, that's what I think about this business. Let me know what you guys think in the comments. Let me know if I missed anything, and yeah, make sure to hit that like button, and I'll see you in the next video.